Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning and welcome to Tuesday, the final one of the month. It's the 30th of January 2024 and this is Peter Lewis welcoming you to Money Talk for an update on the latest business and finance headlines from across Asia. This podcast is sponsored by Surfin Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, a Hong Kong court has ordered China Evergrande to be wound up after it was unable to come up with a restructuring plan that would satisfy international creditors, despite months of talks. Evergrande has about $327 billion in liabilities. And while Evergrande is listed in Hong Kong, almost all of its assets and the vast majority of its liabilities are in China. In theory, the ruling could pave the way for liquidators to attempt to seize control of some Evergrande assets in mainland China, since Hong Kong has a mutual recognition agreement on insolvency and restructuring that applies in some parts of China. China has moved to officially limit short selling. The China Securities Regulatory Commission said that starting yesterday, there will be a complete suspension of the lending of restricted stocks. Investors who buy shares will not be allowed to lend them out for short selling within an agreed lock-up period, the Shanghai and Shenzhen bourses said on Sunday. And the measures are designed to create a fairer market order, the CSRC said. China plans to merge three of the nation's biggest bad debt managers into Sovereign Wealth Fund China Investment Corp. Three asset management companies, China Cinder Asset Management, China Orient Asset Management and China Great Wall, will be incorporated into CIC. China set up a quartet of bad debt managers in 1999 to clean up banking sector debt following the Asian financial crisis. But the distressed asset managers expanded beyond their initial remit and then themselves began to pose a risk to the financial system. In the US, the Federal Open Market Committee will begin its two-day monetary policy meeting later today and deliver its decision in the early hours of Thursday morning, Hong Kong time. Traders in the Fed funds futures markets are assigning an almost 98% probability that the Fed will leave rates unchanged at the upcoming meeting. However, markets are pricing a 45% chance of an interest rate cut in March, which is down from 85% a week ago, and a total of 133 basis points of cuts in 2024, which is down from 165 basis points a week earlier. On today's Money Talk, we're joined by Mark Michelson, Chairman of the Asia CEO Forum at IMA Asia, Karine Hirn, Partner and Chief Sustainability Officer at East Capital Group, and our US Economics Correspondent, writer and broadcaster Barry Wood. Please do get in touch by going to my website and posting any questions or comments there, peterlewismoneytalk.substack.com, or on Facebook at Peter Lewis Money Talk. On X, I'm at Money Talk R3.
Peter Lewis's Money Talk.
On Wall Street Monday, US stocks advanced at the start of a week that will include the Federal Reserve's first interest rate decision of the year, the latest domestic jobs report, and quarterly results from the biggest tech companies. The S&P 500 climbed 0.8% to a new record high of 4,928. The Dow also reached an all-time high, adding 224 points, or 0.6%, to close at 38,333. The Nasdaq Composite gained 1.1% and settled at 15,628. Bonds rallied, sparked by news that the US Treasury Department expects to borrow $760 billion in the first quarter. That's below the previous estimate of $815 billion. As a result, the yield on the 10-year Treasury note fell 6 basis points to 4.08%. The US dollar index was unchanged. The dollar was 0.4% weaker against the yen at 147.5. And in Shanghai, the dollar rose 0.1% against the yuan to 7.18 renminbi. Gold rallied to end near the high of the session as the dollar reversed course. It closed 0.6% higher at $2,031 an ounce. And Brent crude oil settled 2.1% lower at $81.83 a barrel on Monday. Chinese equities lagged behind regional peers on Monday after a Hong Kong court ordered property developer Evergrande to be wound up. China's benchmark CSI 300 index shed 0.9% despite new restrictions on short selling of Shanghai and Shenzhen stocks. Hong Kong's Hang Seng index edged up 125 points or 0.6% to 16,077. Healthcare and technology stocks led the declines after a US lawmaker proposed a bill to ban Chinese biotechnology companies from doing business with the US government. Wuxi AppTech tumbled 10.6% in Hong Kong. Zhongzhi InnoLight declined 10.5% in Shenzhen, and TCL Zhongzhuan fell 10% as well. Trading in the Hong Kong listed shares of Evergrande and two of its subsidiaries was halted after the High Court's ruling. And before the trading halt and following the court order, shares in Evergrande fell almost 21% to just 16 Hong Kong cents, while outstanding dollar bonds issued by the developer traded at deeply distressed levels. One bond maturing in 2025 was trading at less than 2 cents on the dollar. And subsidiaries Evergrande Property Services and Evergrande New Energy Vehicle Group also called for trading halts according to filings with the Hong Kong Stock Exchange. Looks like the Hang Seng is going to slide this morning about 120 points according to futures markets, projected to open about 15,960. And you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
It's Tuesday morning, plenty to get through this morning, so let's welcome our guests. Mark Michelson, Chairman of the Asia CEO Forum at IMA Asia, is with us. Morning, Mark.
Good morning, Peter.
And also joining us.
Good evening, Barry.
And also joining us once again, Karine Hirn, Partner and Chief Sustainability Officer at East Capital Group. Nice to see and hear you, Karine.
Good morning.
And of course, as always on a Tuesday morning over in Washington, D.C., we have Barry Wood, our US economics correspondent, and it's become a tradition to get the Washington, D.C. weather forecast before we start the show.
Cold, raw, winter. Not good.
3 bad words.
But could be worse. The snow is gone.
Okay, well, at least you're comfortable there. They're great. Now, look, a Hong Kong court here has ordered China Evergrande to be wound up after it was unable to come up with a restructuring plan that would satisfy international creditors. That's despite months of talks. High Court Judge Linda Chan issued the order on Monday, 8 weeks after the debt-laden property developer won a surprise reprieve in the long-running lawsuit. Since then, Evergrande, which has about $327 billion in liabilities, has made little progress towards clinching a restructuring agreement. And Judge Chan said, "I consider that it's appropriate for the court to make a winding up order against the company, and I so order." And the judge's order will allow a liquidator to attempt to take control of Evergrande's assets outside of China, including Hong Kong-listed subsidiaries, and that were part of the failed restructuring negotiations. Now, Evergrande's listed in Hong Kong, but almost all of its assets and the vast majority of its more than $300 billion in liabilities are in China. And in theory, the ruling could pave the way for liquidators to attempt to seize control of some Evergrande assets in mainland China, since Hong Kong does have a mutual recognition agreement on insolvency and restructuring that applies in some parts of China. Mark, it's not a surprise, this, is it? But nevertheless, I suppose it does, now that we've reached a denouement in the case of the Hong Kong courts anyway. It puts this all in sharp relief, doesn't it? Just how difficult this problem is going to be for property developers on the mainland.
It does, and it has direct effect on a lot of the companies we work with, because even if they're not directly related to the property business, some of them are in various ways. Some of them have rented, have relationships with Evergrande, and of course other property companies, some of which are also in trouble or are questionable. And so this just adds to the unease that's going on in the China economy. There's some bright spots as well, but this doesn't help. And the development isn't that unexpected. It still does put it in sharp relief, as you indicated.
And of course, this liquidation process is going to highlight just what little legal protection is probably afforded to offshore investors of Chinese assets.
Exactly. If I may come in here, I think it's actually very interesting. I mean, as you said, this is not a surprise, but the question now is how is this going to be implemented? 90% of Evergrande assets are onshore. A lot of them owned or operated by local units. So I think there is much more at stake now than what is. I mean, first of all, the size of this company is just unprecedented. So the liquidation itself is unprecedented. So how it's going to take place? I mean, we will expect probably this to take place. Of course, it's not going to be quick. It's going to take several years. But the real question, I think, as well, is how Hong Kong as a place for where the judgment, the legal judgment has been announced. How will this be enforced in mainland China? And this is also happening at a time, of course, when we have this really acute pessimisms around China in general, and especially for the real estate. I take actually the positive side of it, that maybe this is also what needs to take place before we can get somewhat to a more like constructive sentiment around the sector and around China, because this has been lying really like a wet blanket. But obviously, I think everyone is aware of the issue because of its stake, but also the fact that there's so many unfinished property projects around China, and especially within Evergrande, and of course all these contractors, subcontractors that need to be paid at a time again of course of a fairly weak economy in China. So the big question really is how Beijing itself will try or not try to intervene and see where I mean some probably some aspects of it they will need to come and intervene, so that they don't want to end up in a situation where there's social unrest across the country. But the more they do towards Evergrande, the more they would have to do toward maybe other real estate developers in the future and everything. So it's very complicated and worth following very closely for sure.
Yeah, I just want to add to that. Of course, I agree. I also think it's a test of how Beijing and Hong Kong will cooperate.
Exactly.
Especially going forward. Of course, we've heard a little bit about the judicial cooperation. We'll see how that goes, but also among regulators. And this is another test of that.
But isn't it true, Mark, that surely this was coordinated between the Hong Kong authorities and the Chinese authorities?
Yeah, sure, but it's a question now how it works going forward. How it actually is implemented or not implemented.
This, Barry, is making international headlines, of course, including over there. I guess, it's just yet another reason for international investors based in the US for not being positive on Chinese stocks and not wanting to get involved in the Chinese stock market at the moment.
Absolutely. I don't think anything more can be said than what you've just said. Clearly, I think international investors will stand back and wait to see how this begins to play out.
Do you think, Mark and Karine, that this could finally prompt Beijing to try and come up with a solution for the property developers? Because someone somewhere, these losses are going to have to be written down, aren't they? Someone somewhere is going to have to bear the losses. The only balance sheet that is big enough and clean enough to take those losses is the central governments. Do you think it's going to prompt them to try and finally come to grips with the problem, which is not something they've really been willing to do so far?
Well, I think the whole issue with real estate developers starts because of Beijing's decision to rein in what had been seen and was, and for sure was, like uncontrolled growth and of debt and creating oversupply in the industry. So I think that actually, in a way, they've already done and it was needed. What is interesting is that for a lot of issues, a lot of these big companies, there's always this thing about it's too big to fail, and you've got to give it actually to Beijing that it's been. They have made a decision to act, and it's a very brave one with a lot of implications and consequences, and a difficult, challenging one for sure. But I think at this stage they cannot start back down and say that, oh, so we shouldn't have done that, or it's too late. I mean, they should just. I think they will just have to implement and keep going for quite some time, and it's going to be for sure painful, because the whole issue, of course, with real estate sectors in China is the fact that a lot of this debt is actually also somewhat related to more the fact that people, prepay for their apartments. So if there is no more trust in the system, what is already a challenged sector in terms of appetite from Chinese consumers is going to completely vanish, of course, because who would you? I mean, how it's like exactly in a way that you have a bank run in a system, and you don't want to put your money in the bank because you don't trust the bank anymore. It's exactly the same. It's I think what the Chinese government will have to do eventually is kind of really completely reform the system with this prepaid model not sustainable going forward. And if they don't change the system, it will the market itself will go through like a structural correction and a multi-year decline, which has already started, but it will go on for a long time.
Mark, I suppose
you would think this would have to accelerate what the Chinese government has to do. And Karine sort of outlined what some of the options are. Some of those aren't going to happen tomorrow, but I think they have to indicate that they are trying to move in ways that might help alleviate the issues, because this will just put it more in focus and make people more nervous, frankly.
The problem is, Mark, the Chinese government doesn't have a new plan, does it really, for property developers as to how they are going to fund themselves, given that the old model, as Karine says, doesn't work anymore. But we don't have a new model yet.
No, apparently not. When you say a new plan, we're in campaign season in the U.S., and all the candidates have plans, some of which aren't very clear, and in this case as well. But I think this we'll see what happens, might put added pressure on the government to come up with something more specific. I'm not sure if we'll get a detailed plan. Yeah,
one thing, sure, looked at from afar, it's hard to see how this can bolster consumer confidence in China. Yeah. And I would think that has to be a priority for the authorities, because the consumer has got to feel good about the future if he's going to get out of this sort of hunker down mentality. And I mean, does the big bang, I suppose this is the classic dilemma of any government. Do you come in big and thus potentially terrify people, saying, my God, what do they know that I don't know? Or do you, as the Chinese authorities are doing, do it piecemeal, bit by bit? This is bit by bit, is it not?
It is, but also actually, to be honest, this Evergrande liquidation that scares off investors more than the consumers themselves. I don't think it's like people who just worry about. Of course, if they have bought and paid already for an apartment from Evergrande, and they sure will be very worried. But this is not new. I mean, this has been going on for quite some time already. What we can still see, of course, is that these issues related to real estate markets are also partly regulated and driven locally. So we've had during the weekend now for instance, some latest relaxation in Guangzhou. And why is that so? Is that because, of course, it's a very important source of financing and funding for the local governments. So I think it adds to the complexity of the topic. Is that clearly, of course, it is somewhat centrally run, but at the same time, the implementation on a local level might be quite different. And we have situations where some cities are completely desperate, especially after years of weak growth and costly COVID policies. Measures to be implemented. So we also have this element of complication. At the same time, the market itself has been quite restrained in terms. They've been like regulations and restrictions in many places. So they could ease the sentiment and support the consumer sentiment by just doing some small things in some of these bigger cities. At least I think we should be less worried maybe about the bigger cities and more worried about the second, third tier cities where there I think the situation is fairly grim and the governments do not have much to stimulate and support this sentiment from consumers.
Mark, the news also today, which is sort of linked to this, isn't it, and just shows how difficult and how widespread this problem is the news that China's distressed asset managers themselves now need to be bailed out. They're going to be taken over by the Sovereign Wealth Fund, and they were set up in turn back in after the Asian financial crisis to help some of the banks out of trouble and take on their bad debts. And instead, they've expanded beyond their remit. One of the areas they expanded into, of course, was buying the debt of China's property companies. So this is all very much linked, isn't it? And this is all sort of snowballing at the moment.
On top of the shadow banks. Having some issues as well. So, yeah, it increases the concerns and the worries, and its psychological impact as well as everything else. Sentiment is going to be affected, and so as I suggested before, I think this puts added pressure even more on the Chinese government to try to at least send signals that they're moving toward figuring this out, even if they're not going to do that right away.
Okay.
I don't know if they'll be able to do that. Let's see.
All right,
I read recently somebody, sorry, I thought it was a good one. It was like, just to say, basically, we have this issue like a twin disappointment in the macro and disappointment in the policy. And we all know the reason for both of them. And the question is, of course, you cannot really, you cannot resolve both at the same time. But I think what investors are expecting and hoping for is to get at least a sign that one of this disappointment might suddenly, not suddenly, but maybe just gradually reduce, and not much is needed to create actually a much more positive sentiment when you are so negative. That's something we've learned after, investing for 26 years in emerging markets. It's when the sentiment is at its poorest that you might get the best opportunities. But you need to really, you need to navigate here very carefully because clearly there are a lot of issues. So it's like walking around on a landmines and just trying to be safe, so to say. So complicated for investors for sure. And you have all this situation, and at the same time you have in the US, which seems just to go from strength to strength. So it is for investors like us who are specializing in emerging markets, sometimes it feels like quite challenging to keep talking about all the good things you can see in emerging markets, because there are still a lot of good things in emerging markets when you have this level of concerns and things in the US that almost seems like everything is just going in the right direction and very, very strong. So.
All right, well, while we're on the topic of emerging markets, we've had a request from a regular listener to the show. Bruce Simon has asked us to talk about the expansion of the BRICS alliance and what that means for those economies, and how, if they're going to be ending up competing with some of the more developed economies, and whether, in fact, they're going to dethrone the US dollar. If you have any topics that you want us to discuss, of course, please do let me know. Go to peterlewismoneytalk.substack.com, and we're happy to try and answer any questions you had. But Barry, BRICS, the expansion of BRICS, we've spoken about this before, but do you see this as ultimately challenging the Western world of G7 countries and ultimately dethroning the US dollar?
Well, I think part of what you said is indeed the objective. This reflects a perception among all the participants in BRICS and those who are lining up to join that you have a multipolar world, and that the dominance of the G7 countries in Europe, Japan, United States, North America is in fact not appropriate for the world in which we live. The problem is that the BRICS countries are not unified, and as Mark can tell us, there's very little to hold them together. But if you go back to the 1960s, when you had, the Group of 77, and you had the non-aligned movement that was really powerful or at least perceived to be powerful in an emerging new world. This is the reincarnation of that. China is the dominant player. India does not want China to be the dominant player, and they're both members. But for their own reasons, they see value in BRICS. South Africa is a bit player. Brazil is a bit player. And Argentina, which was asked to join and agreed to join before their election, Mr. Milei in Argentina says, no, thank you, we're out of here. So you've got now the new members, which are the UAE. Now that's important because they're cash rich. And you've got Egypt, which has a lot of people. And then you've got Iran, which is sort of an outlier. And finally, Ethiopia. So it's hard to see how they're going to unify and do something together. Now, you mentioned, can they displace the dollar? They would like to have, and certainly China would like to have, the renminbi gain. And India's perspective is they want local currency in trade, and they're probably getting that. There's been progress made. The tangible effect of 15 of these annual summits of the BRICS is that they have a new development bank based in Shanghai, which is beginning to lend money. That's a plus. And they would like to have something that would rival the payment system that is dominant in the West. So I think it's something that would be mistaken to dismiss, but it would be very equally mistaken to overrate the prospects of this new entity displacing the dollar or becoming dominant. It's not going to be dominant in the global economy, and it's not going to be dominant in payments.
The way you described this, Barry, the idea originally of BRICS was it was an economic concept, wasn't it, to sort of address the growing weight of some of the major emerging economies. But really now it seems to be a much more political concept and less of an economic concept these days. Do you see that's the way it's going?
Yeah, I do. But again, it's hard for the countries to really unify. I think the real test is what these new countries do. I mean, the United Arab Emirates is a very significant addition. Wouldn't you say, Mark?
Yes.
I mean,
But Saudi as well.
Yeah, Saudi. Yeah, I was going to say Saudi.
Yeah, you forgot, Barry, you forgot Saudi Arabia.
And that's a very important omission. I'm sorry, because Saudi is even richer. So, yeah, and the fact is, look what the Chinese did with Saudi Arabia and Iran. I mean, putting together a kind of cooperative framework for those two countries that are always at each other's throats. This is positive. So I think it would be a mistake to dismiss the BRICS.
Mark?
Yeah, I don't. They definitely shouldn't be dismissed. They were. This is their 15th anniversary. It happens to be. Of course, it came out of a paper by Jim O'Neill, then with Goldman Sachs, now Baron O'Neill of Gatley, over 20 years ago about this, and it was taken up. But they never have fit together very well. Look, the new membership now adds about 28.5 trillion. It's now 28.1% of global output. But G7 is 43% of global output, even so at this point. So that's one measure. But what Barry mentioned is the key. Yes, they're going to. This is the global South. They are going to challenge the existing order and the existing institutions, and they're not alone. They have allies who want to do this, and a lot of countries that are uncomfortable with the U.S. dollar still dominating, as it has for 80 years or so, not counting anyway. But I think what the BRICS at this point the new combination looks economically stronger, but in some ways geopolitically weaker. It may help rebalance the global order, but it's probably not going to replace it, including in the areas of currency, at least at this point. When you just think of the different political systems and cultural systems, there are democracies, there are autocratic monarchies, authoritarian regimes, and Islamic theocracy, of course, Iran. Who, there are difficulties in reaching consensus, which all these groups have. Saying this, it can't be dismissed at all. And certainly one of those areas that they're going to try to make movements in is currency. But still, 90% of all foreign exchange transactions are still in the U.S. dollar. the renminbi only accounts for 3% of exchange reserves at this point. Of transactions, and so it's still in a very strong position. They're going to make moves, and I think they're going to cooperate to a greater degree. But I think especially the relationship between India and China is key, and frankly, it's not very good. And they are the dominant players. Go ahead, Karine.
Yeah, no, I just wanted to mention I agree with you that, I mean, first of all, it is more like an informal club. And,
Yes.
but the reason there is this club is that also we definitely need to see whether or not, the multilateral institutions that we have today should be reformed. And there's been, again, recent calling for that, even by the Secretary General of the United Nations. Because if you say that, oh, well, it is only like 25 or 30% of GDP, but it's a much bigger part of the population, for instance. And also it is a much bigger part of what the economy will be like in the future. So when you have to prepare for thinking about the growth of the world, that's what you should be focusing on. So clearly what we have, a lot of the institutions we have today are reflecting the past, and we need to have more institutions reflecting today's and the future. So, and I think it's one of the key motives actually for this cooperation to take place. But as you both mentioned, I mean, the fact that there are governments with vastly divergent foreign policies will make it very tricky actually to do something about it. And by the way, let's not forget there's also Russia, which actually is heading the BRICS, I think, this year. We're not even talking about it right now, but I mean, clearly the fact that you have a more cooperation between Russia and some countries such as Iran is clearly something that probably the US is watching fairly closely for all reason that we can.
Karine, I agree
imagine,
with everything you just said. And I would add that BRICS have been assisted by two own goals from the United States and the West. The first being the exploding United States debt problem, which certainly undermines long-term the role of the dollar. Secondly, the sanctions levied against Russia, seizing their foreign currency assets after the outbreak of war with Ukraine, is a very dangerous precedent. And now you find the G7 countries contemplating actively taking the proceeds from those, what is it, 600 billion or is it $300 billion?
300 billion. 300 billion.
And giving it to Ukraine. This force, the effect of those sanctions, one effect is you've pushed Russia and China close together. So, I mean, this is a plus for the BRICS, and it's not to be dismissed. It's a real test for Indian and Chinese diplomacy.
Yeah, it's not just Russia and China closer together. It's the whole BRICS. It certainly has accelerated. As Karine said, the BRICS countries are going to be growing much faster than the G7 countries if we're right about forecasts going forward. So that balance is going to change as well. It's how quickly there still have to be alternatives. There have to be alternatives to the system, and we still haven't seen that yet. But certainly, it's going to change and going to put more focus on the weaknesses that Barry just cited and Karine has mentioned as well as in the traditional system, including multilateral institutions, which are in dire need of being reformed. I mean, the WTO is hardly operable anymore in many ways. Mm-hmm. So, for example.
Okay, well, let's move on. The EU's climate chief has warned the EU mustn't be lured into a false narrative that action against global warming is undermining the competitiveness of European businesses as Brussels fights a backlash against its ambitious environmental laws. The EU is planning to cut greenhouse gas emissions by 2040 by 90%. And Wopper Hoekstra, I'm sure I pronounced his name wrong, but he is the Dutch climate commissioner for the EU, has said that despite significant worries, he was absolutely convinced Europe could continue to have a world-class, second-to-none business environment, and that wasn't in opposition to having a thriving business community. Now, I know, Karine, you'll have a few things to say about this, but it is a concern that's being raised by businesses, not just in the EU, is it? It's other parts of the world as well.
Absolutely, and of course, it's started in the US. And surprise, surprise, the US is also now the largest producer of oil in the world and also a largest LNG exporter. So though clearly there are a lot of headwinds and we would love to have more tailwinds at a time when, this is 2024. We had last year the hottest year ever on the planet. We have a huge amount of money that needs to be invested into both so-called climate mitigation, but also climate adaptation, because whatever we're doing now, we know that we already going to be in trouble. So we need to create much more so-called climate resilience around the world. And so clearly, I'm as a chief sustainability officer and working a lot on this with companies and as well with our clients. I cannot say this is good news. I wish we wouldn't have that kind even of discussions, because we're spending more time on it instead of actually really acting, and time is short. But at the same time, I personally also, and I just recently met with some top high representative from the EU that came to Hong Kong for the Asia Financial Forum. I think Europe is actually very ambitious and will stay very strong in its implementation of all these ambitions. The issue here is really that we know that this is going to be, it's such a transformative time we're living in, and there's this concept of just transition, which is really important to remind of. Is the fact that, again, we know that because of this transformation, some groups of people will be suffering more than others, and our ability and the ability of governments to make sure that the pain is less than it could be is super important. Otherwise, we're going to have all kind of movements, which are basically populist movements, because they will say, oh, we're going to have to pay higher taxes, or we're going to have to borrow more money. It's going to be more costly. So let's not do that. Same is happening right now in the UK, by the way, and same. But there's one place where it's not happening is actually China, which I find it positive that we don't have this because they already they've gone through that before, and I think we see more, not less, actually climate action ambitions coming from China, but it is complicated, and what of course is always you can also talk about it, the problem as such as saying there will be more and more people that are against this, but there is also another big trend actually within this movement, which is the fact that you have more as well climate mitigation action, so litigation. So basically, you also have people being sued because they're not doing enough, and governments are being sued because they're not doing enough, especially by younger people. So you have this, this balancing act. And at the same time, you have a situation where it's actually been very good to be invested in oil companies and oil stocks. And with the tension in the Middle East, the oil price keeps rising as well. So you have you have a lot of things at play here, for sure.
Barry, in the US, this is going to be, it is already, isn't it? It's an election issue, not least because Donald Trump is making it one. He says, Barry, that he's going to tear up all of Joe Biden's green policies, and he's presenting it exactly in this way, that it's a choice between being green or having companies that are thriving and profitable. He's saying that this is destroying companies and destroying businesses. So this is going to be front and center, isn't it, of the election campaign?
And it's going to be it's a foreign trade issue as well, both in the EU
absolutely.
and in Europe, and with all these investigations and the potential sanctions, and so definitely.
Barry?
Yeah, I think that the business community is forward thinking and is active, and that's a plus. So Donald Trump, yes, surprise, surprise, the country's divided. Will that view of Trump to tear up these agreements, to push things back, will that prevail? I doubt it, because I think the business community and increasingly the public at large knows that action is required. But it's just another divide in our body politic.
It's a concern for companies here. And we just did a critical issues outlook among our companies for 2024. And two of the issues, one was, there were several issues, one had to do with IT and so on. One was what we talked about earlier, China property and the China economic system, and what's going to happen to that. Obviously, that's big, but also Trump too. And this wasn't political. It was just the kind of issues that we've raised. It has to do with the environment, but it also has to do with trade and other areas. And the organizations, however weakened they are, what would happen to them going forward under that sort of scenario? Very uncertain. And of course, the cliche that businesses don't like uncertainty, still true, I think, to a great extent. And now I think they feel it's even situation has worsened.
It's difficult for companies, isn't it? Because they're coming under pressure from all sorts of directions. I mean, but BP, they had a pledge to reduce their oil and gas production by 25% by 2030. I think they were the first energy company to come up with such a pledge. And now they've got hedge funds taking them to court and trying to get them to cut that pledge. They're in a difficult position, aren't they, some of these companies?
And yes, but I said there are also some companies which are being taken to court by people who are saying they're not doing enough. I mean, eventually, we just cannot build a future based on resources that are being depleted. That's very clear. So the question really is about how long term one can be, and we need to just act together as well. So I wish I wouldn't be too depressed here, because I really think that we have no choice. I mean, we cannot just see as if the world would end tomorrow. And the work that needs to be done really is about trying to find ways to finance this, as I was saying, all kind of investment that need to be put into clean tech, renewable energy, all kind of green transition sectors which are needed, and at the same time invest money into climate adaptation for all the places and the countries in the world which are very vulnerable. A lot of them are, by the way, in the global south. And so it's circling back to our discussion before. That's the highest. I mean, I've never seen I don't think we've had a situation in the world before where there was such a high need of getting together and acting together. And it's unfortunately at a time where it seems that it's the hardest with all the issues we have in the world. So
I think the view that Karine just outlined is largely that of the Chinese leadership, as you mentioned before. I mean, it's not perfect. Of course, they still pollute quite a lot, but they do view it as an existential issue.
Yes. And
U.S.-China relations, you could argue, maybe have been the most productive in that area. Maybe certainly not enough. And I know the two main negotiators on both sides are leaving right now. But at the same time, it shows that at least there's a recognition of the importance of this, and at least that's promising. But
absolutely,
the rest
and
of the
I
news
think it's also. Thank goodness for the European Union and for Europe as a continent, because I don't think there's any doubt the Europeans lead on this, just as they lead on quality of life. And the Americans are divided, but the business community is far ahead of the government. And the problem in the U.S. government, of course, is bureaucracy. You can have all kinds of mandates, but the public turns cynical because it's very difficult to implement.
That's actually an interesting data point. We just had the numbers from fund sales in globally by Morningstar during the last quarter. For the first time, we have a situation where it's been actually a decrease in for these so-called ESG funds globally, but it's mainly because of the outflows in the US, while in the EU it keeps growing. So sure. Just think it's interesting to see that seems that not only the regulators, but also people in Europe have different perspectives on this topic.
They are more
That's not shocking. That's not shocking, unfortunately.
Okay. Finally, the big economic news of the week is going to be the Fed. They will start their 2-day meeting later today. Traders in the Fed funds futures markets are signing an almost 98% probability the Fed isn't going to cut rates today, but they are pricing a 45% chance of a rate cut in March, although that is down quite a lot from where it was just a week earlier. It was 85% a week ago. Barry, the one thing that, of course, is standing out, just how fast inflation is coming down. The core personal consumption expenditure index now 2.9%, below 3% now for the first time since 2021. The Fed really has got to take a bow here, hasn't it?
Well,
Or has it been lucky?
It's not their custom to take a bow, and they won't do so. But I'm sure they're happy. They're very happy. And the trends, as you suggest, are indeed going in the right direction, particularly on inflation, but also on employment. We get an employment report on Friday. This meeting will be important because it will gauge the signals of where we're headed. There won't be any rate change from this meeting, probably not from March, but we do know from officials talking that they would like to decline in rates sometime this year. So I think that's what we'll look for when we have Jay Powell's press conference on Wednesday.
If there's going to be a rate cut in March, as markets are expecting, the Fed has really got to telegraph it this week, hasn't it? It's got to be talking about it now. It can't just turn up at the next meeting in March and suddenly cut rates.
Yeah, that's right. And I think that indeed, I will be very surprised if Jay Powell gives any clue that he is leaning towards a rate cut in March. But that could happen. The fact is that you've got a very strong economy here, and I think that Fed members, FOMC members are happy.
But the markets, sorry, Mark.
No, I was just going to say I'm probably the least expert in this area of anyone here, but at the same time, I'm sort of amazed that it's still 45% that think so. I may be completely wrong, but I would think the chances, unless something very dramatic happens, are very remote.
I'm amazed. I'm amazed that the markets still think there's going to be 133 basis points of cuts in 2024. It's just hard to imagine, isn't it, how the Fed is going to do that unless something bad happens to the economy.
Yeah.
And it's already priced in, and it's actually one of the good arguments about why people should look into emerging markets, because we have a completely different cycle over there.
This is good news, though, isn't it, Karine, for emerging markets?
It is.
This is great
Absolutely.
news for emerging markets. So, Barry, what do you think overall for this year? I mean, you could almost argue the economy is so good. Why do you need any rate cuts at the moment? You could argue, couldn't you, that this is about the right level for interest rates?
Well, I think economists generally see a slowdown ahead. I mean, that's what higher rates are supposed to produce, and that is happening. Let's watch to see if there are personal bankruptcies as a result of people incurring too much debt, and particularly in the property sector, commercial real estate. That could be the event that could trigger a faster pace of rate cuts. But I think that the housing market is held up as well as it has is a strong plus. So we actually have positive interest rates for the first time in 20 years. And I agree with, I think, what is a consensus among us, that early rate cuts are unlikely.
But consumer spending's holding up, the jobs market is holding up, the housing market is holding up. I mean, this is not a soft landing. It isn't any sort of landing at all at the moment, is there? There's been no setback whatsoever.
We're on the runway. We've landed.
Okay. Well, we'll bring you all the latest news on the Fed meeting on Thursday's Money Talk. Thank you all very much. You heard there Barry Wood, who is our US economics correspondent over in Washington, D.C. Karine Hirn, who's partner and Chief Sustainability Officer at East Capital Group, and then Mark Michelson, who is Chairman of the Asia CEO Forum at IMA Asia.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening this morning. I'll be back tomorrow when I'll have more business and finance headlines. To discuss them, I'll be joined by Enzio von Pfahl, who's Capital Preservation Specialist at Financial Shield, and Nitin Dialdas, Chief Investment Officer at Mandarin Capital. With a view from Japan is Tokyo-based journalist and author William Pesic. And if you want some more information on some of the top stories from the region, please take a look at my daily newsletter on peterlewismoneytalk.substack.com. See you tomorrow.
Money Talk